You pay income tax every year, but how much you pay and how complicated it feels depends largely on how the union budget is designed. Budget 2025 did more than adjust tax rates. It changed the direction of India's personal tax system. As we head towards Budget 2026, here are the key takeaways from last year's budget and how it reshaped taxes for individuals. Budget 2025 made the new income tax regime the clear default. Instead of encouraging savings through deductions, the government prioritized simplicity, lower rates, and higher take-home income. For millions of taxpayers, that shifted how tax planning works and whether extensive planning is even needed. The biggest change was this: no income tax on earnings up to 12 lakh rupees under the new regime. For salaried taxpayers, that threshold effectively rose to 12.75 lakh rupees after the higher standard deduction. Now, this was not achieved through a single tweak. The government raised the basic exemption limit, flattened middle income slabs, and sharply increased the tax rebate under Section 87A. Taken together, these measures eliminated tax liability for a large section of middle income earners. Someone earning between 10 lakh rupees and 12 lakh rupees now pays zero tax under the new regime. Even at 15 lakh rupees, the tax outgo is significantly lower than before. The old tax regime was left untouched. There were no new slabs, no higher limits under Section 80C, and no additional benefits for home loans, insurance, or savings. This sent a clear signal. Rather than improving the old system, the government chose to make the new regime far more attractive. The message was straightforward: fewer exemptions, lower rates, and easier compliance. Budget 2025 was not only about middle-class salaries. Senior citizens received meaningful relief. The tax-free limit on interest income was doubled to 1 lakh rupees, and banks were instructed not to deduct tax unless interest crossed that threshold. Homeowners also benefited. Taxpayers can now treat two houses as self-occupied without paying tax on notional rental income. Tenants saw compliance eased as well, with the TDS threshold on rent raised sharply. These steps reduced paperwork and improved post-tax income without changing headline tax rates. There were no cuts in corporate tax rates. Those remained stable. However, startups received a major boost, with the profit-linked tax holiday extended to firms incorporated until 2030. Compliance was eased by removing higher TDS rates for non-filers and extending the window for filing updated tax returns. The emphasis was less on fresh incentives and more on stability and trust. The changes reflected a broader policy choice. Instead of pushing savings through exemptions, Budget 2025 put more money directly into taxpayers' hands. The idea was that higher disposable income would support consumption, boost growth, and improve voluntary compliance. With private consumption driving most of India's GDP, that trade-off was deliberate. Budget 2025 was not a one-off tax cut. It reset expectations. As we move towards Budget 2026, the key question is no longer whether taxes will be reduced again. It is whether this simplified, low-exemption framework will be reinforced or quietly rolled back. The old tax regime still exists, but after Budget 2025, it matters far less. Taxes shape how much you earn. They also influence where your money goes. After Budget 2025, tax changes quietly altered incentives for savings, investments, and risk-taking across markets. In the next episode, we'll look at what last year's budget changed for investors and how the investment landscape was reshaped. Follow Business Standard for more budget explainers.